Hello, this is the Advanced Projections August 2022 Economic Report. Let's begin with a reality check straight from a Federal Reserve executive. Quote, "There is a path to getting inflation under control, but a recession could happen in the process. If one does, we need to keep it in perspective. No one canceled the business cycle." Unquote. That's from Thomas Barkin, president of the Federal Reserve Bank of Richmond, in July of this year. Okay, so here's our review of the highlights of the economy from the July data. Employment figures for July came in with a very solid new jobs figure, up 528,000, which now puts unemployment at 3.5%. This confirms what we have been predicting every month since our January report this year, that unemployment would dip to 3.3 to 3.5%. These levels will keep the Fed fully focused on inflation, as confirmed by Chairman Powell and other Fed governors. The second quarter of 2022 had the real GDP down again with a small decline of 0.9%. This added a small amount of fuel to the debate over, is it a recession or isn't it? Technically and officially, it isn't yet. Annual inflation through July was announced on August 10th, with consensus expectations for it to be about 8.7%. The actual reported value was 8.5%. This was dead center within our expectations, as we had expected to see an 8.3 to 8.8% figure for July. August's figure should also fall within that range. The FOMC July 26th, 27th meeting confirmed our expectations of an aggressive Fed plan of action to address high inflation as unemployment continues to stay well below 4%. At this time, the FOMC announced another increase in the target Fed funds rate from 1.5% to 2.25%, adding another 3/4 to the earlier July rate, along with accompanying intentions of additional increases of similar size as may be required in the near term. Equities markets rallied since mid-June based on the solid employment picture, relief from the oil spike, and decent second quarter 2022 corporate earnings reports. Relief rallies within bear markets are common and carry the name bull traps, so many investment banks are framing their bullish advice with some caution. Our indicator system moved our recession risk level up from 80% to 85% this month due to declining leading economic indicators, a very hawkish Federal Reserve monetary policy stance, and newly yellow AP Fed and AP yield curve indicators. There are now no AP indicators in green territory. For details, unemployment remains well below 4% over the past 7 months, now down to 3.5% with new job gains in July of 528,000. We expected those gains to continue in a more restrained fashion, with the Omicron wave essentially under control and continuing with the summer weather. Since the beginning of the year, we have seen others project that unemployment would reach 3.7% by the end of the year, and as we have been stating since January, our own figures fell into the 3.3 to 3.5% range, and we are now there. Yes, an accurate prediction by Advanced Projections made 6 months ahead of the fact. There are still a bit less than 2 job openings being advertised for every unemployed person who is looking for work. Following a 1.5% real GDP decline in the first quarter, the second quarter came in a tad lower than was generally expected, also down at -0.9%. Common understanding aside, these 2 consecutive quarters of real GDP declines are lacking the breadth and depth that the NBER looks for in declaring a recession. Elsewhere, we have written about how the NBER makes their determinations which come with recession declarations well after they have begun. So these declarations are helpful only in a historical context. But for investors and business planners, they need to have a better system of recession leading indicators, and that would be us. Year-over-year consumer price index increases and supply chain issues have continued to plague many aspects of the economy, keeping prices and inflation expectations elevated as demands remain above available supplies. CPI figures confirming the onset of inflation during the second quarter of 2021, and they have continued to rise. The March number this year was 8.5%, April's was 8.3%, and May was hot at 8.6%. In our June report, we said everyone should expect at least a few more months that are in the range of 8 to 9%. Per that projection, the June inflation rate came in hot and high at 9.1%. General expectations out just ahead of the July announcement were for 8.7%, but it came in a little lower at a still unacceptably high 8.5%, and within the range we were expecting. However, this prompted a euphoric response in the equities markets, which we judged to be completely unwarranted. By the time the FOMC announced their July rate hike, the yield curve had already priced in a 75-point move. Now, a fairly significant inversion currently exists where the one-year yield now exceeds everything longer than that, except for the 20-year. The key rate spread that we watch, which is 3 months versus 10-year yields, has contracted from a spread on June 2nd of 2.09% to a June 15th difference of 1.59%, then to a difference of just 0.52%, with further contraction in this spread as we expected. Now our yield curve indicator is solidly into the yellow zone today, with that spread down to about 0.25%, 0.26. With the Fed July 27th Fed FOMC interest rate hike announcement, we continue to expect another 75 basis point bump for the next rate increase to be announced in late September. There is a 2-month gap between the July and September meetings. Minutes of the June FOMC meeting had already revealed that the Fed will be resolutely contracting the money supply by unwinding its balance sheet, removing $100 billion or perhaps more per month. They also indicated they do not currently project inflation to be taming down to near 4% until 2024, about the same time they believe unemployment will move up towards 4.5%. As of the date of this report, the FOMC's July meeting minutes have not yet been released. So watch for our September report, which will review the July FOMC meeting minutes. Second quarter 2022 corporate earnings have come mostly in slightly above expectations on average. However, the number of companies who came in below expectations has increased over the normal portions present in these summations. Multiple retailers also warned of a need for heavy discounting in the third quarter to clear accumulated seasonal inventories. We have a chart from FactSet which demonstrates what we just talked about in terms of the larger than usual portion of companies whose earnings have come in below expectations. Now, here are the current underlying socioeconomic details. The Bureau of Labor Statistics, employment, and the Federal Reserve's intentions. During July, again, unemployment dropped 0.1% to a national level of 3.5%, with a better than expected jobs gain of 528,000. That combination translated into a continuing trend of more job seekers reentering the jobs market. In spite of past pandemic-related declines in the labor force, the participation rate began to move up again, beginning in the late fall of last year, and it continues to move up, as is the total number of employed persons. We have an illustration from the Department of Labor that tells of a major jobs milestone achieved in July, which is 100% of the jobs lost in the pandemic have been recovered. We also include a table from the Bureau of Labor Statistics that shows the employment situation at the end of July, with the general improvements in the employment picture we've been experiencing over the past 3 months and as compared to 1 year ago. This is the Standard Household Data Summary Table A, which is a regular feature in our report. The current high employment situation also keeps the Fed absolutely free to be as aggressive as they deem necessary in their rate increase script, as well as in their plans for unwinding their balance sheet, thus decreasing the money supply. They have already stated so within their March, May, June, and July rate increases and within their latest available FOMC meeting minutes. Look for increased activity in these areas when the Fed returns to work in the fall. The June and July 3/4 point interest rate increases have already had a significant effect on the price of oil, driving it down about 25% so far, and hitting energy exploration equities hard as well. As we are facing further significant rate hikes, this is very likely to be a continuing trend downward, with oil potentially back below $80 by the end of the third quarter. Look for replenishment purchases for the Strategic Petroleum Reserve to begin later this year and temporarily supporting prices. Other major sources of energy, namely natural gas and electric power, have not declined at all in sympathy with oil. So those entities who do not rely on petroleum will be paying significantly higher utility bills or energy bills for the remainder of the year. Natural gas prices, in the middle of a bit of a breather right now due to a fire at an export facility, are still up, almost tripling between April 2021 and April of 2022. That will also keep electric power production costs high, as natural gas accounts for about 40% of the U.S. generation mix. In regards to equities, in our June report, we said this: we expect further downside to the S&P and other indices over the coming weeks. Breaching of official bear market levels of minus 20% are highly likely by the end of June. Index volatility is also to be expected. While this prediction has not been completely borne out, as indices began in bear market territory, rebounded upwards that began soon after our June report was released. In July, the S&P 500 broke back upwards from its June low and closed the month of July around 4130, the same as it closed out April and May. That means it is back solidly into bubble territory, and moves made between July 31st and now, August 12th, put on another 140 points still higher. We're expecting resistance to set in around these levels based upon simple index chart reads, but a turnaround in sentiment would depend heavily on some kind of negative news that would counteract the so-called good news from the very slight decrease in inflation for July. That latter fact is the cause for the most recent surge in equity prices. We, however, continue to expect significant further declines in equities and bonds. A return from the current still in the bubble territory to warm market levels would take the S&P down to about 3650, and a correction to the mean would be near 2900. In a typical bear market, negative investor emotions carry enough downward momentum to drive indices significantly below the mean, towards and through the inevitable retail investor emotions of despair and capitulation, when finally the selling ends. There's no current reason to expect anything different this time, as the Fed appears to be highly resolute in their attack on inflation, and that means more significant rate hikes are expected soon. We monitor margin borrowing as one of our tools for indicating speculative excesses in the equities markets and for breakdowns in this metric which appear ahead of real economic downturns. Margin borrowing, which finally moved off of historic highs in the first quarter of this year, has in the month of June collapsed by 9.2%. In the second quarter is down a massive 15% and down a total of 25% from the peak set last December. This is continuing evidence of something that is seriously discouraging even more of the risk takers from borrowing to finance equity speculation. Now, a very brief paragraph on the state of the pandemic. If the current Omicron variants of concern remain as manageable and minimally fatal infections, we will keep watch over it, but no longer report on details of the pandemic and its evolution. Other marginal public health concerns are popping up with spreading cases of monkeypox and discovery of poliovirus in New York City wastewater. Should anything significantly nasty pop up again, we will, of course, include its progress and effects in our reports. For our complete monthly macroeconomic report, including current recession indicators and recession probabilities, you can get free member access via the link in the description below. Be sure to like this video and subscribe to our channel for pertinent economic updates. Thank you. Feel free to leave any questions you may have in the comments below.